Hello. In this session, I would like to show you how stress tests are designed and applied within the RiskValue framework. Stress testing is gaining a lot of attention among all financial institutions at this point. We are all increasingly skeptical about the assumptions behind value at risk models. That's probably the main reason. Actually, stress testing should focus on risks that might be poorly managed by our VAR modeling. Also, for reasons that we will see later on, stress tests are particularly useful when applied to hedge funds. In fact, VAR models often behave poorly in different types of hedge funds. Let's see, for example, the hedge funds that follow static strategies. These funds often may place a bet on regarding the future occurrence of events which historically have been very rare. But in this situation, it is obvious that because value at risk will most probably be based on the same data used by the manager to place his bet. This means that for the VAR model, this event will also be quite rare. So the value at risk figure will show to be quite small. But this is not at all an independent view of risk management. If we think at a fund following dynamic strategy now, what these funds do, typically they buy and sell when some specific events happen across time. But in such a situation, the long-term cumulative risks that are present are typically ignored by VAR models, which in most cases focus on the short term. All regulators today want to see that adequate stress tests are run within all organizations, including yours. Let's see, for example, what the European regulator, ESMA, says about this. So what ESMA says is that the stress testing program must be in line with the overall risk profile of the UCITS fund. It should capture all risk factors, and most importantly, those that are not adequately captured by the VAR model, maybe liquidity risk, maybe counterparty, maybe operational. It should be run at least monthly, and everything concerning stress testing must, of course, be documented. Before showing you the system, I would like to tell you a few words about how we may help you in designing stress test scenarios which are appropriate for your situation. In order for us to design an appropriate stress scenario for a hedge fund, we need to understand precisely what kind of strategy it is following. By doing so, then we will be able to design the appropriate stress scenario which stresses particularly that strategy. Let's take an example, a hedge fund following a static strategy. For example, long-short CDS on different paired names, or maybe on different tenors, or maybe CDS against a bond, or maybe long-short different index tranches at different attachment points. So in these situations, in these relatively simple situations, the stress scenarios would be either idiosyncratic movement of CDS spreads, or maybe changes in the term structure of the spreads, or maybe bond versus CDS liquidity premium, or it could be the base correlation curve across the index or between different indexes. Let's take a look at a different example, a hedge fund following a dynamic strategy. Let's say that this fund borrows pound sterling and sells against US dollar in the spot FX market whenever the forward rate doesn't seem to be justified against what is observed in the current market. So in such situation, the stress scenario would be to generate dynamic paths of both foreign exchange and the interest rates, and then try to simulate the buy and sell decisions across each such simulated path. So now let's move on and let's take a look on how stress tests are actually designed and applied within the RiskValue engine. Actually, the RiskValue system can accept multiple time horizons in any stress test. This is a weakness that we find in many other systems. Although in reality, in the real world, a stress test obviously is not instantaneous. A stress test is something that has a beginning and it lasts for a number of months, during which several things happen. So when you apply a stress in such a way, not one-off, let's say 15% US markets down, etc. But when you apply this path, this scenario, which in reality is a path, you can ask yourselves and reply to different types of questions, like, for example, how many months can you survive? Can you live with this kind of scenario? Or what will your NAV or other characteristics look like after some period of time, after some months? Another characteristic of the scenarios that you can design within RiskValue is that you can, instead of having just one scenario with a set of specific changes, you can have different severity levels within a scenario. So you build actually one scenario, but you have different variations of the core scenario with different severities, so that you can assess, after you apply all these scenarios, you can assess which one is most likely to happen, or how likely maybe a certain severity is, and what kind of impact this would have on your portfolios. The scenarios, whether you design them on your own or whether we do it for you, can start in different ways. One way to originate a scenario is the empirical way. This means that the system looks at the past and at a period in time that you tell the system to check, and so the system will read what kind of changes took place in that historic period, either in relative terms or in absolute terms, or different ways to do this, and it will then try to apply that historic stress to today. Some questions might arise, of course. For example, equities that did not exist at the time, what do you do with them? We have different ways to handle such kind of problems. Another type of scenario, another way to originate a scenario would be expert-based scenarios. This means that you define, or somebody else who is expert in some markets defines, what may be a bad situation in a given market. Ideally, this needs to be done for all markets. Of course, you cannot just take one market and assume that everything else remains static. That's where the predictive scenarios come in. So here, the system, based on the covariance matrix and other factors, it will try to estimate changes in the factors that you have not specified. So you only specify what change you expect to see in, let's say, in the US market, and the system will find a value that makes sense for the Asian market. So let's take a quick look at what the scenario design functionality looks like within RiskValue. This is a query form where I can take a look at all the scenarios and all the severity levels that have been created within the system. I have different filters if I just want to see a few of them. Actually, I can store within the system a very large number of scenarios. They can all reside there, so that I can pick whenever I need to apply some of these. I can pick them from the screen. So here there is only one scenario that corresponds to the criteria selected. Let's take a look at this scenario, the stress scenario Euro curve. So we can see here that this base scenario has two severity levels here in the sub-scenarios section. One is called Euro curve plus 10%. The other one is called Euro curve plus 30%. Let's look at one of them. So the first severity level, that is. And I can see here a different the set of risk factors that have been stressed for this scenario. In this situation, it is different tenors of two yield curves, actually, the Euro default curve and the Euro Spanish curve, the sovereign Spanish curve, only for 1 month, the latter. But of course, I could, if I wanted, I could have stressed other types of risk factors here also, like equities, credit spreads, foreign exchange, anything else actually. Let's take a look at this risk factor, the Euro 12-month tenor, and look how this has been stressed. So under this, I can see a number of periods that have been stressed, meaning how this tenor, how this risk factor will behave over time under the stress situation. So I could store here that for the first week, let's say, of the stress period, I would like the rates to go up by a number of basis points. Then from the start of week 2 until the end of the month, I want a different change type. And then for the month 1 till month 6, something else. Here we have defined only for one period changes, so it's a constant change. Actually, this is a relative change of 10%. So every day, because this is a daily, the way it has been defined here, every day we will see a 10% increase of a relative change of the interest rate, of the 1 year interest rate. In order to apply now this stress scenario, it's very simple. All I have to do is go under risk management and select stress revaluation. So here it is. So to the left side of this screen, I am asked to select the portfolio. I can select one or more portfolios where I want the stress scenario to be applied. Let's say I would like to choose this portfolio. I'm choosing group company, this managed account, to apply the stress scenario. And here to the right, I can see a list of stress scenarios that are available. I can tick this one. Now I have defined only one, that's why there's only one here. But if I had many scenarios, I could tick many of them actually, so that the stress scenario would be applied simultaneously. All these stress scenarios would be applied simultaneously to the selected portfolios. And I can go take it one step further to select here a range of dates where I would like the scenario to be applied. In addition, if I look here at the bottom of the screen, I can select different calculation profiles, that is different models that are hiding behind each profile in order to apply this stress test. For example, I may have one profile that has exponential weightings for the calculation of the volatility and the correlation, or maybe it applies a certain Black-Scholes or other model for the evaluation of options, etc. And finally, another way to generate a stress test is by reverse stress testing. This means that you need to apply a large number of stress tests. You will of course be helped by the system to do this, until you find the scenario that would break your institution. Any stress scenario would of course include significant drops in prices of various asset classes. However, what we need to pay special attention in our stress scenario is to think of changes which might look extreme in a Gaussian framework, but which are probably not that extreme in a framework that includes distributions with fat tails. Besides the fat tails, a stress test scenario should also address situations where the correlation structure does not behave normally, like the Gaussian model. In this chart here, we can see the yellow line is the model line, is a correlation between two markets, which in normal situations have a correlation of 50%. But we can see that to the left and to the right, the correlation is, of course, much lower. This seems to, when we compare this to the real world, we can see that on the right side, this seems to be more or less correct, meaning that when one market has a huge, let's say, increase because something happened in the US, it doesn't mean that the Asian market, let's say, will have the same positive impact to that extent. However, if we go in, if we look at the left side of this chart, then we see that in very bad days, although the Gaussian model predicts that the correlation goes down again symmetrically, but in the real world, this is not at all the case. So in the bad days, when the US is badly hit, the Asian markets are badly hit as well. This kind of situation is addressed by the RiskValue engine with the capability to design conditional correlation matrices. So the system will build correlations using only points in the time series of risk factor prices where there is a change, either positive or negative, larger than a certain value that you have predefined. This slide displays more or less the same problem in a slightly different way. So to the left side, we can see the joint movements between two correlated risk factors in the Gaussian world. That is how most models are designed and applied today. While if we look on the right side, we can see how the real world looks like, and we can see a concentration, actually an important concentration to the lower left corner. So we can see that at that point, at that area, there are more points than would have been expected by the Gaussian model. Another typical problem is to generate a stress scenario for a yield curve. A yield curve has, of course, many different tenors, maybe 17 or 20 different tenors, most of which, or all of which, might be important to calculate the net present value of cash flows of a bond. So it's quite difficult to generate these. Typically, one might try to use a correlation among these different risk factors in order to project potential values in the future. But this is not a good approach. Different problems are around the corner that might give strange values and strange shape, actually, to such a yield curve designed in this way. One of the ways that we follow to address this kind of problem is the use of PCA, principal component analysis. So in this case, all these, let's say 20 factors are summarized by three factors. One factor representing the trend of the curve, another which represents the tilt, and another a curvature. So it is possible to stress any of these or all three, let's say combined risk factors, in order to have a result, an end result, a yield curve that is much more reasonable than would have been obtained otherwise. Let's take a look at one of our stress testing reports, see what that looks like. Here, this is our web-based report viewer once again. I will click on the stress scenarios category, which could have several different stress test reports. Here we have just one. Let's take a look. So I need to select here a portfolio in order to see the different stresses that are available. I will select this general stress scenario, the stress scenario Euro curve. I'm pressing view report. So I can see here the results of my stress test. What I can see is that this portfolio has a revaluation net asset value of 23.8 million before stress. Once I apply the 10% stress scenario, I will get a loss of 24,000. And if I apply the other severity level, the 30%, then I get a result of a loss of 11,000. This can also be shown on this chart here. The blue is the unstressed situation, and here I have the two stress results. Now I may look further where this loss comes from. So I can see here clearly among the different instruments that are found in this portfolio that the majority of the losses come from the bond instrument with all 24,000 and 11,000 loss. This is almost the entire amount. So I can drill down further in the bond instrument in order to see the specific bonds, the specific instruments that are hiding behind this. And I can see here there are two bonds in this portfolio causing the loss, and the biggest one by far is this PT-OTE bond with a loss of 23,000 and 7,000 respectively. Although it is also clear that among the valuation, which is only 3.5 million, it is not the majority of the overall net asset value for this portfolio. Finally, if we want to combine these two concepts of value at risk and the stress test, we can borrow this methodology that is now applied to banks. It's this methodology of stressed VaR. So this means that instead of calculating VaR based on recent volatilities and correlations observed from the market, that banks now need to calculate these parameters based on a stress period. So they come out with a VaR which is not VaR for today, but it's a VaR that would correspond in a stressed period. RiskValue incorporates this solution. So although it has been designed originally for banks, it is applicable also to hedge funds. So closing this presentation, I believe we have seen many challenges in designing meaningful stress scenarios. We need to be creative. We need to understand the strategies which are behind the hedge fund. And we need to solve several model-related problems, like, for example, the fat tails and the non-Gaussian correlation structures. We can help you in the design of such scenarios. Once we have designed them together with you, we apply them on a regular basis so that you can check the results on different positions that you may have. And finally, we also update these scenarios whenever needed. Thank you for your attention. If you need any additional information, please do not hesitate to contact us. The email is noted here, or you can visit our website, or by other means, other social media that are displayed at this point.